In this video, we look at a strategy which uses a well-known signal called the golden cross. I'm going to test out this golden cross strategy on 10 different Forex markets, and then out of those 10, I'm going to pick the best one, and then we're going to improve, develop the strategy even further into what could be a very usable little trading strategy. A golden cross is a signal which uses two moving averages, uses a shorter moving average and a longer one. And the bullish signal, or the buy signal, comes when that shorter moving average crosses above the longer moving average. And here's what Investopedia says about this well-known golden cross. So what is the golden cross? The golden cross is a chart pattern that is a bullish signal in which a relatively short-term moving average crosses above a longer-term moving average. The golden cross is a bullish breakout pattern formed from a crossover involving a security's short-term moving average, such as a 15-day moving average, breaking above its longer-term moving average, such as a 50-day moving average or resistance level. As long-term indicators carry more weight, the golden cross indicates a bull market on the horizon and is reinforced by high trading volumes. We're not going to be looking at trading volumes because we're looking at 10 different Forex markets. Now, in the diagram down below, we've got a nice little drawing. You see the chart pattern with the candlesticks, and then the two moving average, the shorter one being a 50 and the longer one being a 200. The golden cross occurring when the shorter one goes above that longer one. We're going to be using the 50 and the 200 just because they're the most well-known or well-talked about when looking at the golden cross. We are actually going to include what's called the death cross in this trading strategy too. The death cross is the exact opposite of the golden cross. So the death cross is the bearish signal or the sell signal, and it's where the shorter term moving average crosses down below the longer term moving average. This essentially makes our strategy a stop and reverse type strategy. That means that once we've got a buy signal and we've got the golden cross, then we only exit once we get the death cross signal. So not only do we get out of our long position, sell out of our long position, we actually take a new position short in the opposite direction. That's a stop and reverse strategy, and it means that we're always in the market. However, we are going to look at using a stop loss, and there are going to be occasions with the strategy where we will get stopped out at our stop loss for a loss, and then we will be flat on the market. But for the majority of the time, we're going to always be in the market, either long from our golden cross or short from our death cross. I've tested this strategy out on a 30-minute chart of 10 different Forex pairs, and I've already mentioned that I'm going to be using a 50 period for the short moving average and a 200 period for the longer moving average. So let's go to the computer and see how this strategy performs. For this test of the golden cross and the death cross, we're going to be using data from Oanda dating back to the 1st of January 2008 through to the end of December 2018. And what that does, that leaves us a couple of years extra out of sample data to look at any changes that we might make to the one strategy that we're going to modify, and to see whether the performance has continued to perform into the future using that out of sample or unseen data. So firstly, let's look through the 10 charts and see which ones work the best. The first one we're going to look at is US dollar, Canadian dollar. It's a 30-minute chart, and I've put the moving averages on this chart so we can see. And the cyan line is our shorter or 50 period, and this pinky purple line is the 200 or the longer moving average. So you can see when the cyan crosses over the longer pink moving average, here's our buy signal. And if we scroll along a little bit, we can see that the averages didn't cross here, not quite, but the cyan line came down below the longer term moving average. So here's our exit from our long position, which is in profit, and then entry into our short position. So dead easy. Let's have a look at the performance of US dollar versus Canadian dollar. And the first thing we're going to look at is the equity curves, and straight away we can see that's an awful equity curve. It's not something that's got consistent behaviour. We're looking for a consistent, nice, uptrending equity curve, and it clearly doesn't work on this market. The next chart we've got is pound versus Japanese yen. And we've got a much better equity curve. It's not so great around these early years, but it's definitely moving in the right direction. We might be able to do something and improve that. So let's continue to look at the others. Next up is US dollar versus Japanese yen. An awful equity curve. There's been bad periods and better periods, but overall there's not a consistent uptrend there, so I won't be bothering with this one. Next is New Zealand dollar versus US dollar. Absolutely terrible. In fact, that's so bad that we might even be able to reverse the rules on that one and make a strategy that way. So that's something to think about for a future development. Next is pound versus US dollar. Similar story, and maybe again reversing the rules we'd be able to produce something that could actually work, but for this strategy, no, it's not going to work. Next is pound versus Canadian dollar. Another bad equity curve. In fact, more of these seem to be badly trending down than actually trending up. So a lot of these, maybe, if we reverse the rules, we might be able to get something better. Next is euro versus New Zealand dollar. That's all over the place, isn't it? Again, reasonable periods, terrible periods, but there's no consistent behaviour over that 11-year period. Next is euro versus the pound. No consistency there whatsoever. We won't be looking any further at that one. Next, euro versus the Japanese yen. Pretty awful. Just gone sideways, hasn't it? Periods where it's been working, periods where it hasn't been working, but overall bad. And the last one we're going to look at is Australian dollar versus the US dollar. And pretty bad again, mostly bad. So we're not going to use that. So if you haven't already guessed, we're going to be looking further into the pound versus the Japanese yen, because this one has the most consistency. This one has the best overall behaviour over that 11-year period. Looking at our first workspace then of pound versus the yen, you can see these signals where I've got the moving averages on the chart again, and let's just remind ourselves of the performance. We're looking at the equity curve here, which, you know, it is okay. It's probably, it might be something tradable. It's not great, but it's certainly something to work with. The net profit, 7.4 million yen. An average trade of 9,700, which is just about acceptable probably for this pair by the time we've taken some trading costs out. We got a low win rate, but that's, as with any of these sort of trend following systems, that's not something that's out of the ordinary. So the first thing I want to do is to include a stop loss. So in this next workspace, I've done an optimization looking at the stop loss between 0 and 500 pips. We can see that in this column here, 0 to 5. Multiply these numbers by 100 to get the pip value. And looking down the net profit here, we can see that some of the best values are anywhere between 160 pips, 200 pips, 220. So I'm going to settle for around 200 pips. Let's look at the performance. Our average trade has gone up now to just over 13,000. That's much better. We're making more net profit actually, 10.2 million. And the curve is possibly slightly smoother in the later years, but it's still not great, but it's okay. But we're going to try and improve this further still. The way I want to go about improving this strategy, or trying to improve this strategy, is looking to filter some of the trades as normal. And rather than doing what I normally do, what we're going to look at is trading day of the month. So are there certain days of the month where, taking the signals from the golden and the death cross, are there certain days of the month where it's a more powerful signal and that signal leads to a trend? I don't know. We could be taking better signals around the middle of the month, maybe at the end of the month, maybe at the start of the month, but that's something that we can test. So for every day or trading day of the month, if the first trading day of the month is the 2nd of April, for example, that's trading day number 1. Now, months can have up to about 24 trading days because we're not including weekends with the Forex market. So this is the next optimization that we're going to look at. So the first optimization, I looked at the starting day. I've called it a TDOM start, trading day of the month start. So we're looking for a time window. I've left the end to be the end of the month currently. So if we start at 1, we're going to be taking every trade throughout the month. If we start at 10, then we're only going to be taking trades from trading day 10 through till the end of the month. And we won't be taking any trades if we get signals from the first day through to the 9th day of the month. Now, looking at this, currently we've got this 10.2 million, and looking through the results here, the best one is around about trading day 16. However, look at the amount of trades. We've only got 205 trades because we're really filtering them out compared to the 776. So I'm not so comfortable with filtering that many trades out. We've got a much stronger average trade. However, I would rather stick with a usable 13,000 or 15,500 and keep more trades in, because sometimes that can lead to less over optimization of a strategy. So seeing as trading day 2 makes more net profit and a higher average trade than trading day 1, I'm going to use trading day 2 to start with. So currently we won't be taking any trades on the first trading day of the month. And let's see how that performs. The equity curve is slightly better throughout this earlier period. It's pretty similar through the rest of it. We're making more net profit at 11.3 million now, and we've got a higher average trade of 15,500 yen. Now, obviously, the next thing to do is look at when to stop trading throughout the month. So in the next optimization, I've optimized the end day, or the TDOM end, as I've called it. And I've optimized from day 2 through to day 24. Now, again, being mindful of not filtering out too many trades, looking at these total trade values, I find that the best result is trading day 21, because we've got the best net profit and we've got a very good 17.6 thousand yen average trade. So that means really that we're only realistically filtering out from day 22, 23, 24 some months and trading day 1. So we're not filtering out too much, which is good. So let's have a look at how that performs. We've got that higher average trade, 17.6 thousand yen. We're making more net profit at 12.2 million. And the equity curve looks a little bit better again. So this early period is not quite so sideways, and we're making new highs near the end of the data. So that's good too. Let's have a look at the annual period analysis. And we can see throughout those 11 years, we've only got 2 losing years. 2008 was pretty small losing year too. And I've actually decided that although there is many other ways that we can start to improve this strategy, I'm going to leave that there for the minute. And what we're going to do now is we're going to apply the same strategy, and we're going to use that out of sample data from 2019 through to April 2021 to see if the performance has continued in that unseen data. But before we do that, if you're finding this video useful, please hit the thumbs up button now and subscribe to the channel if you haven't already, because that does help the channel out. So in this workspace, if I show you, we've got data from 2008 through to 2021, and we can see on the chart the data is up to the 8th of April 2021. So let's have a look at the performance. Looking at the annual period analysis, we see that we didn't have a particularly good 2020. We had a very good 2019, and so far 2021 is looking positive. We're going to have more net profit. Obviously, we've got more trades, and the equity curve is still moving up. We've got new highs here around March 2020, so that's 15 months into the future from the end of 2018, but we have gone a little bit sideways since then. So hopefully that will recover and we start to make new highs. Let's have a look at the average trade value. Hasn't really changed much, has it? At 17.7 thousand, so that's good. Our largest losing trade is still 200,000 yen, which is of course our stop loss value. Now, I haven't been using any trading costs, any slippage or commissions within this test, so what we can do now is we're going to add some slippage to see how that affects the performance. If I include 4,000 yen per trade, which is equivalent to 4 pips, trading at one full lot, and let's have a look now how the performance has changed. And we can see that our average trade has dropped 4,000 because that's our 4,000 that we just included. Largest losing trade has gone up a little bit because we've got some commissions and slippage in there now. But let's have a look at our equity curve. And the equity curve hasn't really changed too much. This period of 2020 has tended to go down rather than sideways, but we've still got these new highs here, and overall it's an uptrending equity curve, which is good. Of course, there are ways that we could look to improve this strategy further still. We could look at larger timeframes. We could look at whether we're in a larger uptrend or downtrend. We could look at times of the day that we can take these crossover signals. But that's where I'm leaving this study for today. To recap then, we've took that popular signal, or that golden cross, and used the death cross as well. And we've looked at how it performs in a strategy on 10 different Forex pairs on the 30-minute time frame, and found out that it only really worked on pound versus the yen. And then we've made some small improvements, hopefully not over-optimizing as we've gone along. It just goes to show that these common, well-known signals like the golden and the death cross, they rarely work very well. And that's why I like coming up with my own ideas in the hope of discovering edges that aren't already exhausted by the masses of traders out there. As with all my strategies that I develop, I'll continue to watch and monitor this one for another few months, and judging on how it performs, then I'll decide whether to include it in my real account with my real trading portfolio of strategies. But I hope you've enjoyed this video and managed to take something away from it. But until the next one, this is Jared Goodwin, and thank you.